Leaving your job got a 401k, you need to move. Whatever you do, don't just ask your 401k provider to send you a check. That one seemingly simple request can trigger an immediate and mandatory 20% withholding by the IRS. That's money yanked right out of your retirement savings, and you might not see it again for over a year, if you see it again at all. And this isn't some rare, bizarre occurrence. It's a trap that snares thousands of hardworking people every single year, simply because they don't know the rules. But there is a way to prevent it. In the next few minutes, I'm going to give you the one simple phrase that makes sure 100% of your retirement money stays your money, shielded from the IRS right from the get-go. So stick around, because getting this right is one of the most important financial moves you'll ever make. Section 1. The problem. The crossroads of your career and your retirement. So you've done it. You've left your job for a new opportunity, a well-deserved retirement, or maybe you're just taking some time off. You've basically got 4 options. You could leave it with your old employer, but that often means less control and maybe higher fees, now that you're not on the payroll. You could cash it out entirely, but I'm serious here unless it's a true lights-out last resort emergency. Never do this. Cashing out early is a guaranteed way to torch a massive chunk of your savings with taxes and brutal penalties. That leaves us with the most common and usually smartest choice: rolling it over. A rollover lets you move your retirement funds from your old employer's plan into an account you control, like an individual retirement account, an IRA. Or maybe your new employer's 401k. This keeps your money growing tax-deferred and protects your nest egg. This all sounds straightforward, right? You call your old 401k provider and tell them you want to roll over your money. This is where the path splits and where so many people make that one huge mistake. The rep on the other end of the line will ask a seemingly innocent question. How would you like to receive the money? You might think, just send me a check. That seems easiest. Boom, that's the mistake. That one easy choice just set off a financial time bomb. Section 2. The agitation. The easy choice that costs you a fortune. The second you ask for a check made out directly to you, you've just kicked off what the IRS calls an indirect rollover. And because of that choice, your 401k provider is now legally forced. They have zero choice in the matter to immediately withhold 20% of your entire account and ship it straight to the IRS. Let's break down the math, because this is where the pain becomes real. Imagine you have $100,000 in your 401k. You've worked for years, diligently saving and investing to build that up. You call your provider and ask them to send you the money so you can roll it into your new IRA. A few weeks later, a check for $80,000 arrives in your mailbox. Your heart just drops. Where's the other $20,000? It's already with the IRS, sitting there as a mandatory tax prepayment on a potential distribution. Your 401k provider didn't steal it. They were just following the rules. You've instantly lost control of 20% of your retirement money. And believe it or not, the real nightmare is just getting started. Section 3. Agitation Part 2. The 60-day tightrope walk. Now you're holding a check for $80,000. But the IRS has an even more dangerous rule waiting for you: the 60-day rollover rule. This rule says that to complete a tax-free rollover, you must deposit the full original amount of your distribution into a new retirement account within 60 days. And here's the kicker that trips up so many people. The IRS doesn't care that you only got a check for $80,000. In their eyes, the total distribution was $100,000. To successfully complete the rollover and avoid devastating taxes and penalties, you have to deposit the full $100,000 into your new IRA. But wait, you only have $80,000. So where are you supposed to get the other $20,000? You have to come up with it out of your own pocket, from your savings, your emergency fund. You have to find it somewhere. What if you can't? What if you don't have a spare $20,000 lying around? This is where the financial pain just gets worse. You can only deposit the $80,000 you actually received. The IRS now treats that missing $20,000 the amount that was withheld as a taxable distribution. This means it's added to your income for the year and you'll owe ordinary income taxes on it. If you're in a 24% federal tax bracket, that's another $4,800 in taxes. But it gets worse. So let's tally the damage from that one simple mistake. You could be out the $20,000 withholding, pay an extra $4,800 in income tax, and get hit with a $2,000 penalty. And even if you do have the 20 grand to plug the hole, that money is now held hostage until you file your taxes next year and can hopefully get it back as a refund. It's a logistical and financial mess. Section 4. The solution. The direct rollover and the magic phrase. Okay, now that I've scared you sufficiently about the wrong way, let's talk about the right way to do this, the safe way. The way that prevents the IRS from touching a single dime of your money. The solution is beautifully simple. It's called a direct rollover or a trustee-to-trustee transfer. With a direct rollover, the money goes straight from your old 401k provider to your new IRA provider. Your hands never touch it. Since the money never hits your personal bank account, the IRS doesn't see it as a distribution. And if it's not a distribution, there is absolutely number 20% mandatory withholding. There is no terrifying 60-day clock. 100% of your money, every single penny of that $100,000. In our example, moves safely from the old account to the new one. It's clean, simple, and dodges every trap we just talked about. So what is the magic phrase you need to use? When you call your 401k provider, you need to be crystal clear. You say these 5 simple words: I want to do a direct rollover. They will then ask for the details of your new account. Now, sometimes they'll insist on sending a physical check. If they do, you need to add one more critical instruction. Make the check payable to name of new financial institution for the benefit of your name. That for the benefit of ULLC. It written as FBO. That language is the secret sauce. It ensures the check can only be deposited into your new retirement account, keeping it classified as a direct transfer and protecting you from all those nasty tax consequences. If you finding this breakdown helpful and you want to keep learning how to protect and grow your retirement savings, do me a quick favor and hit that subscribe button. My goal here is to break down these complicated money topics and give you the clear, actionable advice you need to take control of your future. Your support helps me create more content just like this. Section 5. Other critical rollover landmines to avoid. Okay, so avoiding the indirect rollover is the big one, but there are a few other landmines you'll want to sidestep to make sure everything goes smoothly. First up, match your account types. If you're rolling over a traditional pre-tax 401k, it should almost always go into a traditional IRA. If you roll that pre-tax money into a Roth IRA, that's called a Roth conversion, and you'll owe income tax on the whole thing. Likewise, a Roth 401k should go into a Roth IRA to maintain its tax-free status. Don't mix them unless it's a deliberate strategy you've worked out with a pro. Second, be aware of the one rollover per year rule. The IRS limits you to only one indirect IRA rollover in any 12-month period. This is another great reason to always use a direct rollover, as these are not limited by this rule. You can do as many direct rollovers as you need. Third, if you are age 73 or older, you must take your required minimum distribution RMD before you roll over the funds. RMDs are not eligible to be rolled over, and trying to do so can result in penalties. Finally, follow up. Seriously, don't just set it and forget it. After you start the direct rollover, call the old provider in a week to confirm the funds were sent. Then call your new provider to confirm they were received and, most importantly, invested how you want. Money sitting in cash in a rollover account isn't growing, and that's a huge missed opportunity. Look, changing jobs is a big deal. And figuring out what to do with your old 401k is one of the most important money moves you'll make during that transition. It's a moment filled with hidden traps, but the biggest one is also the easiest to avoid. That temptation to just take the check can lead to an instant 20% withholding, a crazy 60-day deadline, and potentially thousands of dollars lost to taxes and penalties. The solution is simple and powerful. Always insist on a direct rollover. By using those simple words, you make sure that 100% of your hard-earned money moves safely from point A to point B without the IRS getting a piece of it along the way. You stay in control, you avoid the penalties, and you keep your nest egg whole and working for you. Now that you know how to move your 401k like a pro, the next step is making sure that new IRA is actually set up for success. To help with that, I highly recommend watching my next video, The 5 Biggest IRA Mistakes That Can Wreck Your Retirement. In it, I break down the common errors people make after the rollover is complete. Click the video on your screen now, and let's keep building your financial confidence. Thanks for watching.